Good morning, and welcome to today's GT News webinar, Addressing Liquidity, What's Changed, proudly sponsored by State Street Global Advisors. My name is Tarika Adams, and I will be your GT News host. Before we begin, please listen to the following housekeeping points. If you experience any technical difficulties, please type them into the Q&A panel located on the bottom right-hand corner of your screen. There will be a WebEx producer to respond to your message immediately. Questions for the speakers should also be typed into the Q&A panel. We will address as many as possible during the end of the presentation. Please ensure to send your questions to all panelists. Otherwise, we may not be able to read them out loud. Finally, this webinar is being recorded, so if you miss anything or think a colleague would be interested, you will be sent a link to access the recording within the next week. I'd now like to hand you over to our moderator today, Yang Felipe Butler, Head of U.S. Cash Business at State Street Global Advisors. Welcome, Yang, and thank you so much for joining us today.
Thank you, Tarika. Hello, everyone, and thank you for joining us for the State Street Global Advisors webcast, Addressing Liquidity, What Has Changed. I'm Yang Butler, Head of U.S. Cash Business at State Street Global Advisors, and I'm joined by my colleagues, Matt Steinaway, Global Head of Cash Management, and Pia McCusker, Head of Global Credit Research. Most of you have probably received and hopefully downloaded the piece we co-authored with GT News, the Guide to Investing Operating Cash, in which we outlined the mechanics required for effective cash management. More than 700 of you have downloaded the piece, so if you haven't already, we encourage you to do so. We believe as cash investment practitioners, it is very important to fully understand the context in which we are applying these tactics that we outlined in that paper. We don't plan to spend much time going over the definitions of those drivers, as these topics have been discussed at length in various forums. But instead, we would like to take the opportunity to explore how certain influencers, rates, regulations, and ratings have shaped our current investment landscape. Before we kick off the discussion with Matt and Pia, a few reminders to the audience. We are leaving some time for questions towards the end of the webcast. Second, we will also be polling the audience in a few questions during the session to get your mindset on key issues. To submit your questions, please type them in the question box located in the lower right hand of your screen, and we will answer questions at the end of the presentation. With that, let's get started with a quick level setting on our environment, specifically here in the U.S. I believe few would argue that we have lived through some challenging circumstances in the cash markets over the last few years. The era of Yellen is underway, and we are reminded constantly from her public comments that liquidity risk is in need of attention. Next slide, please, slide 3. Actually, if you can go back to slide 3. Between the ramifications of the 2008 global financial crisis, the continued low-rate environment, extremely complex regulatory forces affecting our industry, and finally, a rapidly changing short-term cash marketplace, particularly in ratings, which we will tackle today, we have had our more than adequate share of complex issues to tackle. And when you think about these challenges against the primary investment objectives of principal preservation, liquidity, and yield, we are experiencing a weighty imbalance. So if I may ask the first polling question to the audience, when you think about the issue of rates, regulations, and ratings, which of these influencers would you rank as the biggest cause of this imbalance? You should now be seeing your choices on the screen on the bottom right. And Matt, while we're waiting for our results here, I'm curious, from your conversations with clients, what do you think weighs in top of mind?
So Yang, to be fair, I think our clients reflect on all three rates, regulatory ratings, and have concerns. But I guess from my perspective and being in the markets, trying to implement our client portfolios, we do think rates is potentially the most significant issue. Candidly, if rates were higher and client portfolios were yielding more, the impact of the regulatory and rating environment would not be as significant as it is. So today, when we have low rates and everyone is struggling to meet yield objectives and targets, the impact of the onerous regulatory environment that we're in, as well as the challenging rating environment, is more significantly felt.
So here we go. So some results here. It looks like regulations came at the top of the heap. Regulations and rates are actually tied at 35%, and ratings at 24%. So Matt, why don't we start a conversation there? How do we bring back an optimal balance between these challenges and staying the course in pursuing our investment objectives?
Sure. So we'll talk about today about bringing things back into balance. I think we'll spend some time just talking about the imbalances and what caused them, although I think much of that has been discussed, and then really work into how we think that we can reflect on our fund objectives and bring things back into balance. What strikes me on slide 4 is really thinking about the two different sides of this imbalance. The ones that we have the least control of as asset managers and investors are the influencers. These are exogenous third-party variables that we frankly have very little control over. But on the right-hand side are our objectives, and those are the things that as investors we have complete control over. Some of them will be driven by our ultimate portfolio needs, our client needs, but at the end of the day, while we cannot change the influencers, we certainly can reflect on the objectives, understand the risk and return associated with those objectives, and perhaps make changes to those objectives to best reflect their current market conditions. And I think today that's what we're going to try to spend some time on. So if we go to the next slide, page 5, we're really talking about what's creating the imbalances. And clearly, as I let off, my primary concern as an investor, we are very concerned about the rate levels. Obviously, central bank activities have driven rates globally to lows and on a sustained basis to all-time lows. We are seeing an operating environment that has 0 to 25 basis point Fed funds in the U.S., with the potential for negative deposit rate in Europe in the very near future. This makes investing challenging on a number of different fronts. Obviously, the lack of supply from a low-rate environment is a challenge. As our issuers are reflecting on regulatory changes, which we will discuss, we are seeing significantly less supply in the marketplace around the type of product that we like. This is impacted, obviously, by low rates, but also regulatory and ratings issues. But again, from our perspective, it is reflecting on ultimately the objective of the rate. A yield is necessary for certain portfolios, and really it is the level of risk that you want to take to achieve that rate level. So the low level of rates are ultimately driving an imbalance here as clients are seeking certain levels of yield in their portfolios. To attain those yields, we are increasingly concerned that there are more credit-type structures entering the marketplace to, in effect, stretch for that yield. We are also concerned that there is less differentiation in the marketplace. In other words, the spread between a single A 3-month piece of paper and a double A 3-month piece of paper is somewhat limited. And we think that that really narrows the choices of our clients in terms of the risk that they want to take and ultimately the return that they get. So how do you deal with that as solving for that imbalance? I think there are a couple of different issues. And I think one we need to preface is that the rate environment will not persist indefinitely. While we have felt low rates for some time, we are certainly, particularly in the U.S., entering an environment where rate rises will likely be in the near future. And that obviously takes a different type of investing. It takes a management, it takes a more focused management of different risk types, specifically interest rate risk, and really shifts the focus of the portfolio to one where you might be thinking about credit risk more to one where you're thinking about interest rate risk more. So on a go-forward basis, we do think that rates will rise at some point in the not-too-distant future. And we do think that now is the time for our investors and our clients to reflect on their investment policies, both around credit, which we think is becoming more and more unfairly priced, but also around interest rates and how that risk is managed. Because rates will rise. This will be a new environment. We have not had rising rates for some time. And we've also gone through a sustained period of longer rates where people have been more comfortable taking more duration to achieve their yield targets. So moving on to slide 6, we'd like to talk to you about the regulatory imbalances. I think there has been a lot of discussion around the regulatory imbalances in the marketplace. And we think that meeting the objective of dealing with the imbalances resulting from the regulatory environment is probably a little bit easier as relative to rates. When we talk about the regulatory environment for cash, we are thinking primarily around Basel III, Dodd-Frank, and tri-party reform. These three new regulations have significantly impacted our marketplaces, the cash marketplaces, and our ability to execute our clients' investment strategies. I think a good opportunity or a good example of that is the regulatory environment as it pertains to tri-party repo reform. And I'm going to ask Pia McCusker to reflect on those challenges.
Thanks, Matt. As you know, the new Basel III leverage ratio measures the regulatory capital. Now it's relative to an accounting-based calculation versus a risk-based definition of the exposure. So as a result, you're seeing an overall reduction in repo volume in the marketplace. If you could turn to page 7, please. As you can see, this is data from the Federal Reserve Bank of New York highlighting the tri-party repo collateral by asset type. If you could look at the Treasuries and agency balances from April 2014 versus a year ago, these balances are down 20% from year over year. And from a nominal balances, that's roughly $285 billion. And that's particularly leading to the Basel III calculation because it doesn't matter what the actual collateral is. Because the balances are high, the capital treatment for those assets are the same as if you were looking at an equity-type collateral. And if you look at the equity balances, it's higher by roughly 28%, still nominal of roughly $30 billion, but still you're seeing the increase in that equity class. And as you can see, total repo overall is down 15% because banks are rebalancing their activity that's not constraining to this new Basel III ratio. But as you can see, the opportunities for this particular regulatory challenge is that you are seeing potential for financing non-traditional assets as evidence in the increasing equity balances.
Thanks, Pia. So if I think about this in a portfolio context, we have seen the regulatory environment, I think, has had a significant impact on the liquidity environment for cash management. So if we think about, as Pia walked through, the decline in tri-party repurchase agreement collateral associated with Treasury and agencies, those transactions were largely overnight trades backed by high-quality collateral that were largely used for liquidity strategies and cash management portfolios. It was a relatively low-yield trade, but on a relative basis, relative to other products, it provided a high level of liquidity, and it provided liquidity, daily liquidity. We have seen that product move down. As Pia walked through some of the Basel challenges that we're facing, that type of activity is much less favorable for our counterparties, and they are backing away from that product. However, there are opportunities, and the equity tri-party agreement collateral is a very good example of that. It is efficient for our counterparties to finance that via repo mechanism. We think the risk-return reward on those trades is compelling, and as a result, we have seen the balances in that space move up significantly, given the fact that the overall repo market is contracting. We also think this trend continues. The regulatory focus continues. As our opening quote talked about, Yellen is very focused on continuing reform, and tri-party will continue to be a focus. And we do think increasing reform will work its way into the tri-party market. So our net takeaway here is that the regulatory impact on the client objectives is that there is reduced supply of liquidity, and that cost of that liquidity is incrementally higher. So in other words, if you're running a portfolio that requires 10% overnight liquidity and 30% liquidity, like a 2a7 fund in the United States, the cost to maintain those liquidity levels is significantly higher. However, there are opportunities that are presented, in this case, equity repurchase agreements, where if for clients who are able to take more term risk, in other words, more liquidity risk, there are additional opportunities and what we think are favorable risk-adjusted trades resulting from these regulatory changes. So again, a negative influence that we have very little control over, but we think that with some potential changes to investment policy guidelines, there may be room to take advantage of some opportunities that are created by this regulation. I think another good example of imbalances, turning to slide 8, is ratings. Obviously, throughout the global financial crisis, the rating agencies and their ratings were under severe scrutiny, and their performance I would characterize as perhaps spotty. I think the rating agencies have responded and are modifying the way that they approach their own business, both their business model and how they rate financial institutions and asset-backed securities. And that in itself is creating another imbalance in our marketplace. So again, as we think about our client objectives using their investment policy statement and reflect on principal preservation and liquidity and yield, we think ratings has a significant impact both on liquidity and principal preservation. And on slide 9, we've presented some details which I'll let Pia McCusker walk through.
Pasha, as you know, global regulators are essentially looking to remove the too big to fail status. You have the Dodd-Frank Orderly Liquidation Authority in the U.S. and the bailing-in regime in Europe. So as a result, the rating agencies are lowering their bank ratings. I believe Moody's has the largest uplift of support, and the new standalone ratings will basically have no government support assumption in the ratings. There's really two important factors that are resulting from these rating downgrades, and one is the lowering the ratings will essentially make it challenging to structure and manage a AAA rated money fund portfolio. And second, it's a bigger challenge is that you have an investable universe that is significantly shrinking, and if we keep guidelines as it is, it'll be difficult to participate in the market for these securities. What's ironic, though, is that in this regulatory landscape, banks have definitely a cleaner balance sheet. They have an improved asset quality and capital levels. There's a significantly greater pair of eyes monitoring their activities. You have improved transparency as it relates to the C-card test in the U.S. and the AQR test in Europe. Yet overall, bank ratings are in a downward trend. So what we've done on page 9 is a graph taking all of the bank exposures in the U.S. prime money funds. The data was retrieved from Crane data. So aggregately, the bank exposures is roughly $760 billion. And what we've done in the x-axis is line up their ratings, but notched it down one notch by Moody's. And obviously, the balance is on the y-axis. So as a result, should Moody's downgrade the ratings by one notch, we have roughly about 25% of bank exposures on the left of the line that would fall out of the 287 type fund guidelines. Clearly, a new world of low single-A banks and A2, P2 is going to be the standard norm, and that will make it challenging to structure, as I said, AAA rated money funds.
Can I just interrupt there 1 second, Pia? So given Pia's remarks, can I ask the audience the following polling question? Do you have ratings requirements embedded in your investment policy statement for cash investments? Yes, no, or not sure? And perhaps while we wait for the results, I'll have Matt continue on with slide 10.
Sure. Actually, if you could say on slide 9, I just want to reflect on this because as we did this research, I was very much struck by the dollar amounts that we're talking about here. Mm-hmm. So we're talking almost $200 billion of supply into the front-end space in U.S. dollar cash money market funds that could potentially no longer be eligible for investment in 2A7 funds. So as a portfolio manager reflecting on my access to liquidity for my clients and my access to yield for my clients, this is a fairly significant degradation to our ability to get invested for our clients. I think that, obviously the market will change, and some of these banks may elect to recapitalize to get to new ratings levels. Some of the funds may elect to be able to do different things and invest differently, but this is the type of regulatory and rating change that we're talking about that has significant material impact on how funds are run. I think the other thing that Pia touched on quickly, I think is a very important point, is that there are a number of, Moody's specifically and the rating agencies generally do rate money funds at a AAA level. And I think what we have seen since the crisis is there is obviously a reduction in the number of AAA banks, AA banks, and now we're moving to a weak single A banking model. And I think if we reflect on that and how you get to a AAA money fund, I think it's easy to conclude that would be a very challenging environment to try to maintain AAA-rated funds for investors. That isn't to say that it can't be done, but I think that investors need to acknowledge that to have a AAA-rated money fund will be a very low-yielding or relatively low-yielding event in the future. So, moving on to slide 10.
So just to, before we proceed, Matt, 78% of the audience currently say that, yes, we do have a rating requirement for our IPS for cash. 7% said no, and 13% are not sure.
That's great. Thank you, Yang. So finally on page 10, from my perspective, just talking about portfolio considerations and how we think about constructing portfolios in this environment. And really the conversations that we want to have with our clients about the new regulatory rating and yield environments, and really how do we deal with those issues to best construct portfolios that meet their needs. I think first and foremost, the issue that we talk about with clients the most is the expensive portfolio liquidity. It is very expensive given the absolute low rates and the challenges offered by the technical supply issues that we've discussed to maintain high levels of portfolio liquidity. And then if we fast forward a year and reflect on the rating changes that we've discussed here and potentially additional regulations impacting the tri-party markets, the expense of maintaining portfolio liquidity will be even higher. And in Europe, potentially it could be negative, where it actually costs the investor money to maintain high levels of liquidity. And again, by liquidity, I'm referencing things 90 days and in. I think the important data point here is working with clients to understand actual portfolio liquidity needs. We have had a number of conversations where clients were surprised by the actual level of liquidity they were maintaining within their portfolios and how there was a disconnect between their actual underlying cash flow needs, so the cash flow needs of their operations and investments, relative to the liquidity that was being offered either by their commingled or separate account basis. So we have been working with clients who are in separate accounts to think about the actual level of liquidity needed within their separate account. And for clients who are in commingled vehicles, whether there wasn't a different mix of commingled vehicles that offered them still continued access to daily liquidity, but also potentially other types of funds that may offer additional yield at the expense of liquidity. So this is a real issue in front of us. We don't think necessarily that this changes as rates rise. So again, rates will rise, hopefully in the not too distant future. However, we think on a relative basis, because of the regulatory impact, the rating changes, and the supply technicals, that portfolio liquidity will remain expensive on a go-forward basis. The second portfolio consideration that we talk about a lot with clients is the expensive portfolio capacity and diversification. And this gets back to the points that Pia made on the ratings, that in order to maintain a strong single A and or AA portfolio that is diversified, it can be very, very expensive. That paper is at a premium, and to generate sufficient diversification and maintain a competitive yield can be very, very challenging. The question is, how do you deal with those issues? And again, I think from Pia's perspective on the research side, there have been a number of changes to the banking system, as she outlined, that while the ratings are going down, the quality of the banks, the fundamental underlying banking systems has actually gone up. So we're faced with an odd quandary where the rating agencies are pointing us in one direction, but the actual fundamentals of the business and the business model and the regulatory systems are pointing us in another. I think that is a important consideration for our clients, is thinking about the ratings paradigm within which their investment policies operate. Is it still necessary to have, say, AA minus ratings? Should the average rating quality be lower? What are the risks that you're taking by doing that? That isn't to say that we would advocate necessarily chasing ratings down. What we are saying is it is worth reflecting on looking at your investment policy, understanding the rating construct that you have in the investment policy, and understanding the implications of having that rating construct. There is an expense to everything, and we think that given the change in the current environment, there may actually be a real expense to maintaining a higher quality rating portfolio that isn't necessarily warranted by the fundamentals of the underlying credits. And finally, in terms of portfolio considerations, as with any portfolio, a cash portfolio is all about a trade-off of risk versus yield. And we are looking at an environment where we have had low rates for a very long time. We have had significant credit spread compression, and we think we've had a very challenging risk-return environment. And we do think now is the time where clients need to revisit that risk versus return expectation and risk measures to really reflect on, are they taking the right level of risk? Are they taking the right level of risk? Have they reflected on interest rate risk in some time? And should they be reflecting on the controls that they have around their credit risk in their portfolio? Because we do think after long sustained periods of low rates that certain risks can get masked in portfolios, and as rates rise, those risks can become more evident within the portfolios themselves. So again, we are strong advocates of engaging with clients and working through and discussing each of these issues. We think that is a very important time to be doing that given the changes in the marketplace. We also think there's tremendous opportunity for clients to restructure portfolios in a very, very favorable risk-adjusted manner to obtain the yield objectives they desire.
Next slide, please. So given everything we've discussed, it may sound basic, but we believe the following key takeaways are extremely important for clients to follow through. Utilize and engage with your managers and have an in-depth, candid discussion around where risks lie in your cash portfolios. And if you have not yet done so, revisit your investment policy statements and ensure it is reflective of the current cash investment environment. As a final polling question to the audience, I'd like to pose, do you plan on reassessing your investment policy statement for cash investments in the near future? And while we wait for the results, perhaps we can tackle a few of the questions that have come in. I think this one is for you, Matt. With Basel III expected to potentially reduce the attractiveness of non-traditional repo asset classes, how important is it to have scale in repo, and would that be an advantage?
So I think as the tri-party repo market has gone through changes over the past several years, I do think that scale is increasingly important in the repurchase agreement market. In speaking directly with counterparties, they are consistently looking for stable sources of funding offered by large client bases, and they're also looking for, our clients are looking for expertise in certain asset classes. I do think that the environment has changed for repurchase agreements, where there is much more due diligence around both the counterparties that are being transacted with, but probably most importantly and most significantly around the collateral that is being taken from the repurchase agreements. I think that a number of large investors have invested capabilities both around collateral surveillance as well as collateral testing, and I think that scale is important when considering an asset manager who is participating in those markets on your behalf.
So just a quick update on the polling question. Approximately half, or 47%, said yes, that they are planning on reassessing their IPS shortly, and about 29% said no, and 22% are not sure. So we have another question that's come in, and perhaps this can be directed to both you and Pia, Matt. What are the 3 things a large risk-averse corporate treasurer should watch out for in the next year?
This is Pia. Certainly with regards to some feeling of complacency in the market, I think you should be very cognizant of the risks that are in the portfolio, understanding those risks, having a disciplined process in knowing those risks. For instance, some of the things that you're seeing in some of the portfolios are non-traditional exposures to countries or asset classes, and by having a disciplined process, you really need to make sure that you understand the risk for those portfolios.
Yeah, I agree, Pia. Those are great points. I think from my perspective, as Pia talked about, being cognizant of the credit that's going on in the portfolio, we still have challenges where there may be banks or banking systems that are well rated, but on a relative risk, we may not be so comfortable with those names or sectors, as Pia talked about. I would also be careful of duration extension over the coming months. As people are looking to potentially chase yield down the curve, when I think everyone is of the belief that we're going to have rising rates, I think it would be a challenging time for a portfolio manager to extend interest rate duration in any portfolio at this point in time. The other piece, and we talked about liquidity, I would be very aware of how my portfolio manager is maintaining liquidity within a fund. What instruments are they using to get liquidity? How are they getting liquidity? Is it via maturity? Is it via presumed sale of some security, either via credit security or a treasury security? Is it repurchase agreements? Is it bank paper? I think the composition of that liquidity and the risks that you take to get there are critical because, as we talked about, the expense of liquidity has gone higher and different managers are looking for different ways of solving for that problem.
So another question, Matt, in what ways do you see the yield curve changing over the next 6 months?
Sure. So that is the question. So I will keep my comments to the front of the curve since that's where I transact. Our expectations are that rates that an official policy rate increase does not occur until the second or third quarter of next year. That is our official economist team prediction. But given that, obviously, as you look out 6 months, you would expect some instruments to begin to reprice as we roll into that time period. So if we think rates are going to rise in, say, August of next year, then certainly you would expect to see a one-year T-bill begin to reprice and reflect that increase in rates. Having said that, we do think there are some challenges associated with that. Clearly, right now, we are trading in a range of policy rates. The official range is 0 to 25 basis points. Currently, Fed Open usually is sort of 7, 8, 9, 10 in that range. That will need to migrate towards the higher teens, lower 20s before the Fed can actually implement a rate increase. So we would expect that the Fed to begin to take steps to increase rates in the front end. We think that the facility they will be using, the reverse repo facility, will be the first place they do that. But I would caveat all of this is that the Fed is very sensitive to the market's perception of a rate rise, and so they are not going to take unnecessary action. So while it is intuitive to us when you do a break even that the longer dated money market instruments should begin to price in a rate rise at some point in the third quarter of this year, there are also market technicals that will keep rates low in the money market sectors, particularly treasuries. And also, I think the Fed will not actually take actions to increase rates as it pertains to the Fed facility until probably the first month of next year, January of next year, once we're done with turning off quantitative easing. So I think we'll be in a period in the next 6 months where, frankly, we're not going to see a lot of movement in rates. But I do think as we move into next year, the front end will begin to price in the rate hikes that are currently expected by the market. And you see that in Fed funds futures to trade away from the front end of the market. I will caveat all that in saying that this is all dependent upon the current trajectory of economic data, which we do not expect to change. In fact, could grow more favorable over the next couple of months. But if things were to change significantly, either for the worse, where economics get worse, or for the better, where we start seeing wage inflation, then all these expectations could change.
I think we've got one final question. Basel III liquidity rules penalize banks that take cash from financial customers, yet the majority of funds portfolios are invested in bank risk. Can prime liquidity funds survive this dichotomy in the longer term?
I mean, that's another good question. A lot of, obviously, what's available in the marketplace is primarily coming from bank paper. And unless you have, other asset classes that could potentially participate in the market in size and in volume and diversity in terms of issuers, banks are primarily the only issuers out there that you could participate in the market. I mean, you could add asset-backed securities, but clearly those are probably not considered for prime liquidity because they're obviously longer tenor and have structural risk that you have to take into consideration.
Yeah, I guess from my perspective, it's an interesting question because it gets down to banks are penalized. It's primarily in the 3 months range. So if we think about the penalty for the liquidity coverage ratio under Basel III, that really is 3-month paper and in. So I think this gets back to the expensive portfolio liquidity is that these exposures will still be available to money funds. They'll be available to money funds 3 months and out. The curve might be a little bit flatter than it's been historically due to technical pressures, but there will still be the opportunity to invest in banks 3 months and out. Having said that, I think, as we talked about here, the expense of liquidity, so everything from overnight to 3 months, will prove very challenging. And I think that the ultimately where we settle on those, on that 0 to 3 months is going to depend on a number of factors, 287 reform being one of the big ones here in the States, but also subsequent tri-party market repo reform that we're still waiting to see. But I do think that 0 to 3 month space where a lot of portfolio liquidity is maintained will be challenging. It will keep T-bill rates lower on a relative basis than they have been at some time, and that really is where the impact is going to be seen in these portfolios.
Great. Thank you, Pia. Thank you, Matt. And thank you all for joining State Street today for this webcast. We'd like to also thank our partner at GT News. As I mentioned at the start, you're able to download a few resources on our website that offers useful guidelines on how to use your investment policy statement, if you have one, to support strategic cash management opportunities. If you have any further questions or would like to contact us after this webcast, our contact details are on your screen. We'd very much love to hear from you. Thank you again for your participation and have a wonderful day.